Imagine you've just bought what looked like the perfect investment. Glossy brochure, guaranteed rent, easy returns. Then, 6 months later, the developer vanishes, the building's not finished, and your deposit's gone. We've seen this story play out too many times. Across the UK, investors are falling victim to increasingly sophisticated scams that are stealing their progress and sometimes even their retirement. So in this video, we'll show you how to protect yourself before it happens. You'll learn the new wave of property scams catching investors out this year, the tactics that make even experienced buyers fall for them, and the simple checks that can save you thousands. So let me tell you how this first one usually starts. You might be at a property event or maybe just scrolling through Instagram. And out of nowhere, you'll be promised 10% returns on a luxury hotel room. The pictures look incredible, it's fully managed, hands-off and hassle-free. There's a rooftop bar, a spa, even a map showing how close it is to the airport. And if that's not enticing enough, the entry price will be way lower than a normal property. So you think, why not? It feels like a no-brainer. You book a call, you get the glossy brochure, and the salesperson is really convincing. They might say things about it being a limited allocation, or they might tell you about clients in Dubai who've been snapping them up left, right, and centre. It feels like you're getting into something exciting and sidestepping all the hassle that comes with normal property investment. But here's where it unravels. Because although it's marketed as a property investment, it's really more like a business. You're not buying a tangible asset that you can sell. No one wants to buy a second-hand individual hotel room. You can't even value it accurately because these units rarely trade on the open market. And you can't switch management companies if the current one does a bad job. You're stuck, all because you bought into a business that depends on occupancy rates, management competence, and perfect economic conditions. And the same is often true for other more obscure investments, such as student pods, assisted living units, and storage facilities. We've actually been approached to sell these dozens of times over the years, and the commissions they offer are enormous. But we've turned down every single one, because we've seen how it ends. Dubious rental returns, no growth in value, and almost no chance of getting out. It's one of the most convincing traps in property because it looks legitimate. There's a title deed, there's a rental projection. It's all done through solicitors, just like any other property purchase. But you're buying into something you have no control over, no way of getting out of, and no recourse if something goes wrong. If your normal buy-to-let isn't working out for you, you'll always be able to take a bit of a hit on the price and walk away. But with one of these, you just need to cross your fingers really hard that the payments keep arriving. Because once you step into the world of non-mainstream investments, it's incredibly hard and often impossible to back out. Now, this next one always starts with an unmissable deal that you can't wait to get your hands on. Maybe you're scrolling through Rightmove or Instagram and see an ad for a shiny new development in a hotspot like Manchester. We're talking luxury apartments, 20% below market value. And only a limited number are available, so you need to act fast. The brochure looks professional, the artist renders are stunning, and the agent reassures you that you're getting in early before everyone else finds out. They'll show you charts comparing projected value on completion with today's price, and maybe even mention a famous regeneration project or a new transport link coming soon. It feels like a shortcut to building instant equity. Buy now, lock in the discount, and profit the moment it completes. But here's the catch. That 20% discount? It's often 20% off a price that was never real to begin with. This isn't true for all off-plan deals, as we'll see. But every time we look at one that's being heavily marketed, we find that the developer has simply inflated the starting price. So when they say you're getting a discount, you're actually buying at or even above market value. There's a reason why a huge proportion of these are marketed overseas, where buyers don't know the market particularly well or have the tools to check what they should be paying. So while the ads give the illusion of instant profit and the agent makes you feel like you've outsmarted the market, in reality, you're at a disadvantage from the start. The good news is you can get genuine discounts. We do it all the time. But it takes connections, a lot of negotiation, and deep local knowledge. So whenever you're told you're getting a discount, don't just take their word for it. Compare the price against actual local comparables, properties that have recently sold in the same postcode. If there's a gap, find out why. There's always a chance that this investment is genuinely better than those that currently exist locally. And although people talk about the new build premium as if it's automatically a bad thing, of course something shiny and new is going to cost more than something that's 10 years old. But often these off-plan developments genuinely are overpriced. As ever, a good rule of thumb is If something is plastered all over the internet and people are trying really hard to push it on you, it's highly unlikely to be a great deal. In fact, when we secure deals for our clients, it's normally completely exclusive to us, and it's a condition of the deal that we don't openly share it online. But the only way to know is to do your research and perhaps get some independent advice from someone who knows the area. You can also sign up for our free property investor toolkit, and we'll share the best places to invest in the UK, a spreadsheet to run the numbers, a guide to help you find the right tax structure, and more. You'll find a link in the description. Now, if an exclusive discount isn't enough to convince you, this next trick usually seals the deal. You'll hear something like, "We're offering guaranteed rental income for the first 2 years, completely hands off." And of course, it's enticing. Who'd turn down a steady income from day one? No tenant worries, no expensive surprises, and far less risk. But the problem is that that so-called guarantee is almost never what it seems. Let's say you buy one of these apartments with a guaranteed 8% yield. In theory, this means that if the expected rent is £800, you'll still get £800 even if it sits empty, or even if they can only find a tenant to pay £500. It feels safe. But the money doesn't come from some magical insurance policy. It comes from the developer or the management company. And where are they getting their money from? Well, you. In other words, they're paying your rent out of the cash that they're collecting from investors, which means you're highly likely to be overpaying in the first place, as they'll need to build in a buffer to pay the guarantee out to you without their own profits being hit. And when that cash runs out, the guarantee quietly disappears. We've seen it happen so many times. The management company folds and suddenly there's no guaranteed rent and no one to chase. Even when the company survives, it often doesn't end well. Because once that guarantee period ends and the rent resets to the real market level, the numbers usually don't work anymore. You're left holding a property that was only ever profitable on paper. If the deal is genuinely strong, it doesn't need a guarantee to sell. So the moment you see guaranteed returns splashed across the brochure, take a step back. Ask yourself, if this development is such a good investment, why do they need to offer a guarantee at all? And before you go ahead, make sure you're confident that demand will be strong and the numbers would work even without a guarantee. Because when the guarantee ends, and it will, you want to be holding a solid real-world investment, not a promise that was only ever there to make the numbers look good. To explain this next problem, I want you to imagine you find a new development in an area that's seen a lot of growth in recent years. There are modern office blocks and a train station nearby. And every time an apartment goes up for rent, young professionals are queuing outside the building. So when you see a new luxury apartment building going up, you're already half sold. The sales agent asks for a deposit of just 30%, as it's off plan, but the rest isn't due until completion. You've got the cash and you're confident you can get a mortgage. So initially, that sounds fine. But there's a serious risk here that the developer is using investors' deposits to fund the construction itself. So if the project stalls, runs out of money, or the company collapses, that's your money gone. We've seen this play out far too many times. Buyers hand over tens of thousands, thinking they're being proactive and showing their commitment. But all they've really done is hand the developer free working capital, without any of the protection they'd get from the bank. Now, to be clear, most developers who ask for big deposits aren't dodgy. They're fully intending to complete the build. But even so, you're taking on too much risk. Things go wrong all the time for reasons beyond anyone's control. But you don't want that to become your problem. If you pay a deposit of 10% or less, it can usually be protected by a guarantee scheme. So if anything goes wrong, you get your money back. Beyond that, you're on your own. So the 10% rule is one we're never willing to break. We recently came across an opportunity that ticked every single box and then some. It was perfect, except the developer was insistent on receiving a 20% deposit. They were experienced and highly reputable, so the chance of anything going wrong was very small. But even a small chance is too much when you're talking about tens of thousands of pounds. So we had no choice but to walk away. So if you ever feel pressured to act fast, or you're told that we can't hold the unit without 30% down, walk away. Because once that deposit leaves your account, you're taking on the developer's risk. And if they don't make it to the finish line, you're the one who finishes last. After everything I've just told you, this next one might sound like a massive contradiction. Because on the one end of the spectrum, you've got developers asking for 30% or more up front. And on the other, you've got people claiming that you don't need any money at all. You might have seen this type of strategy online, usually in a YouTube advert or on TikTok, with someone standing in front of a sports car saying, "I built my property portfolio without risking any of my own cash." And years ago, this might have been possible. 20 years back, when lending was loose and banks were throwing money at everyone, you could sometimes secure great deals with little to no cash up front. Back then, it was known as a daylight remortgage, which was withdrawn around the time of the financial crash in 2008. But even then, they were simply no deposit deals. Calling them no money down would have been misleading, because there's still stamp duty, legal fees, and all the other costs associated with purchasing an asset. And now those days are long gone. So when you hear no money down, take it with a massive pinch of salt. Things like lease options, delayed completions, vendor finance, they sound clever, but one wrong clause can cost you everything. Because these techniques are complicated, risky, and depend on layers of legal and financial nuance that most beginners don't have the first idea about. We've met plenty of investors who've tried to copy these ideas straight from a course or seminar. They spent thousands learning creative ways to buy, only to gradually discover that almost every opportunity is unsuitable. Maybe they can't find any sellers who are interested, or the numbers don't stack up, or they need far more capital than they were originally made to believe. Now, don't get me wrong, these methods can work, but only occasionally, and only for people who already have experience, strong legal knowledge, and support from trusted professionals. They're tools, not shortcuts. So if you're just starting out, don't get seduced by the idea of buying property without money up front. The only people truly making money from this strategy are usually the ones selling the dream, not doing the deals. Because in today's market, no money down doesn't mean you found a loophole. It just means that you've signed yourself up for a risk that you don't understand. This next one is another example of a scheme that's technically legitimate, but far more trouble than it's worth. It basically involves renting a property from a landlord and subletting it to tenants or short-term guests. You won't need a deposit or mortgage, and every month, when the tenant pays rent, you get to keep whatever's left over after you've paid the actual landlord. But what the influencers and salespeople don't tell you about this model is it's not really an investment at all. For you, it'll be more like running a business. And it's hard work. You'll still be responsible for finding tenants, handling maintenance, and bearing all the risk that someone will stop paying. But you won't have any equity in the property to make it worthwhile. And if you're doing it for serviced accommodation or Airbnb, it's even more demanding. 24/7 management, licensing issues, and occupancy swings that can wipe out your profits overnight. We've met plenty of people who started rent to rent expecting passive income and ended up overwhelmed, stressed, burnt out, and often in debt. That's not to say it can't work. It can, but only if you treat it like a proper business with systems, compliance, and enough cash flow to survive the quiet months. If you go into it thinking it's going to be something hands-off, you'll be disappointed. Because rent to rent doesn't make you a property investor. It makes you a property manager, and that's a very different job. For the seventh and final dodgy deal to avoid, let's imagine you're at a property networking event, and you meet someone who's friendly, approachable, and seems to know far more about property investing than you do. After a few minutes, they mention that they're opening up their next deal to private investors. They explain that banks are slow and restrictive, so they prefer to work with trusted partners instead. And the offer sounds really promising. Lend £50,000 for 6 months and earn 12% interest fully secured. And at the end of the day, you know you're not buying a property with them, you're just lending money. So it's not like you're walking into the arrangement expecting it to be something it's not. But here's what many investors miss when agreeing to these joint ventures. Those slow and restrictive lenders your new friend mentioned, they probably said no for a reason. And it's often because the project is just too risky. If a big lender won't touch it, do you really want to? People trying to attract investors will always make a big deal about how your money is secured against the property itself. And not knowing any better, seeing an official land registry form will make you feel very, secure. But in practice, it's pretty much worthless. So if the project collapses, you're last in line to get paid, if you get anything back at all. This plays out in the property industry over and over again. Developers who raise millions from private investors at networking events, promising double-digit guaranteed returns, only to go under, leaving investors fighting to recover what's left. Some have even been well-known names with impressive-looking projects and glowing testimonials, so it's no wonder people are duped. So before agreeing to this type of arrangement, ask yourself, if their deals are that good, why can't they get funding from a bank or another regulated lender? Legitimate developers have no trouble securing finance through proper channels. Because rather than relying on charm, urgency, or false promises, they stand on solid numbers. Hopefully this video will help you avoid falling victim to disappointing deals and shady strategies. Because not only can these tricks cost you thousands of pounds, they can keep you awake at night and create mountains of work, when the whole point of property investing is to spend less time working and more time living. But even if you avoid everything on this list and stick to good old-fashioned buy-to-let, you could still lose thousands of pounds if you buy the wrong property. So watch this video next, where I show you the red flags you should be aware of before you commit.